The content discussed in this podcast is for informational and educational purposes only and should not be construed as financial or mortgage advice. Always consult with a licensed professional before making any decisions regarding mortgages or financial matters.
Welcome to the Canadian Mortgage Show. Here are mortgage professionals Alex Pang and Alex Shanks to cut through the BS and educate Canadians on all things mortgages and real estate.
Welcome to another episode of the Canadian Mortgage Show. This is episode 38. Alex Pang here, along with my co-host Alex Shanks. Alex, how are you doing?
I'm doing pretty good there, Alex. How about yourself today?
Not bad. Just kind of getting over a little bit of a cold, but we have a pretty important episode today, don't we?
Yeah, I'm excited to talk about it. It's something that I've kind of actually been working on for the last few years, and I know it's something that's coming a little bit more to limelight. I'm seeing more people talk about it, and I thought it'd be a good time for us to break it down for everyone.
Yeah, absolutely. So what we are going to talk about, dedicate this episode on, is cash damming. Now, I've been hearing about this a bit the last maybe year or so, and I've seen other people post about it. I've seen some snippets here and there, and we thought that we dedicate an episode about it. So, Alex, you know more about this. What is cash damming?
So cash damming, we'll jump into Alex. Now, the one thing that I'd like to say on it, this is a very cool strategy, and it can really help you generate more wealth. Now, it's also a super easy sales technique. I can put up on the screen and say, hey, I can save you $1 million. Do you like that? It's great to say you could potentially save $1 million, but this is a strategy that can take anywhere from 10 to 15 years to really take effect. So again, make sure that anytime that you're thinking about doing something like this, you need to speak to a financial advisor, you need to speak to an accountant, and you need to speak to a mortgage broker that actually understands this.
So do you want to explain what the cash damming strategy involves?
Yeah, so the big thing in Canada, we can't write off the interest on our principal residence. Now, in the US, our partners below us, they actually get to write off the interest on their mortgage. Now, the negative for them is they also have to pay capital gains on their homes that they sell. But when you get to write off interest, it becomes a pretty powerful thing. And that is the difference when you're talking about someone that's an employee or somewhere that is a business. And so the premise of cash damming there, Alex, is we're taking your mortgage that's not tax deductible. We can't write anything off on it, and we're actually going to turn it into a tax deductible machine. And there's some nuances of how we actually do that. Now, this is in the CRA Tax Act. It's in section 201C of the ITA. This is a fully legitimate thing by the CRA, as long as you're using a line of credit for investment purposes, you can actually write off that interest. Now, this is where we're going to show you, and we're going to help break down some scenarios and talk about this, how we're actually going to borrow from a readvanceable home equity line of credit to actually pay your mortgage down faster with a rental property. That is what cash damming is. Now, there is other nuances to a strategy like this.
So, what you mentioned about a readvanceable line of credit. So, folks, if you don't know what a readvanceable line of credit is a mortgage with a home equity line of credit attached to it. Now, let's say, for instance, your approved limit is $500,000, mortgage and line of credit combined. In the beginning, you take a mortgage out, $500,000, your line of credit is $0. As you pay your mortgage down, the principal that you pay down becomes immediately available on the line of credit. So that's why it's called readvanceable. So let's say a year from taking out the mortgage, your mortgage is down to $490. Your line of credit limit is $10,000. When it's down to $480, it's up to $20,000 on the line of credit. So and so on and so forth. So that's what a readvanceable line of credit is. So one thing that you brought up was turning your principal residence into a tax deductible expense. Something similar came to mind. Isn't that the Smith maneuver? Is that the same thing?
It uses the same things. Now, the big difference of the Smith maneuver is there's what's called the plain Jane Smith maneuver. There is a debt swap, and then there is a cash damming. It's taking the same nuances as the Smith maneuver. Now, the problem that I have with just the plain Jane Smith maneuver is you can borrow from your home, from the readvanceable home equity line of credit that Alex talked about, to go invest in stocks. It is a tool, but the problem with that is when you go and buy stocks, well, what if that stock goes down tomorrow, Alex, by 50%? Someone is going to sell that pretty quickly. And so I do have some people that do the plain Jane version of the Smith maneuver, and they're very savvy investors. For the everyday person, it's not something that I really would recommend people to get into, because if anything goes wrong and you sell those investments, it's actually cost you more money. But yes, you can borrow it. And the whole thing is, let's say you borrow $1,000 from your home equity line of credit, you go buy a dividend stock for $1,000. That $1,000 on your home equity line of credit is now tax deductible. You also have now invested $1,000. Maybe you never had any cash flow before. You never had any extra money. That's where you can use your mortgage. Now, this is where some people call this a leveraged mortgage strategy in that case, because your mortgage is still at $500, but you've paid it down by $1,000. You've borrowed, so you still owe $500,000 in debt. That's where I personally don't call it leverage. You're not increasing the amount. You're just converting it from a mortgage over to a home equity line of credit to make it tax deductible.
So
Now,
I guess in some cases where, no, just to clarify, this is not really reducing your debt. This is essentially just keeping it the same and just converting it from a non-tax deductible to a tax deductible.
correct.
So maybe it might not fit everyone, because there's some people who are risk adverse and they think all debt's bad. They want to pay off things as soon as possible. This strategy may not be right for them.
So when we get into the cash damming, it's going to be different. You are going to be able to accelerate the pay down on your mortgage. And that's where we'll talk about that difference there, Alex, and how you actually do that. Now, let's bring it back. We know that we can't write the interest off on our principal residence. Now, if you own a rental property, you can write off the interest on that mortgage, your property taxes, your utilities, anything tied to that rental property, you get to write that all off. Now, that's an expense. Your mortgage, your property taxes, your utilities, that's an expense. And this is where we'll actually talk about a scenario after, but I don't want us to throw in numbers right now. But that's where, if you had a rental property or you went and bought a rental property, we can actually pay those expenses from your home equity line of credit. The way that everyone else does it right now is they would get the rental income put into their bank account. They then go pay out their expenses. The only diversion that we are doing in this scenario is we're taking the rental income and we're prepaying the principal residence mortgage. We want to prepay it. It's going to bring the mortgage down, but we are then going to borrow from the home equity line of credit. We now get to go pay those expenses, the mortgage on the rental property, the property taxes, those utilities. You already get to write off all that stuff over on the rental property. We now also get to write it off on our principal residence. That debt has now become tax deductible.
That's a weird way of thinking, because we all kind of, whoever, those of you who invest in real estate and such, most of the time when you have a rental property, the income from the rental property just pays for its expenses. You treat it as its own separate entity kind of business. So what you're saying cash damming is kind of crossing over where the income from the rental goes and pays for the principal, and using the principal to pay the rental expense. Is that basically what you're saying?
Exactly. And this is it just solely for tax planning. That's the sole purpose of this. If you didn't do that, you wouldn't get these tax benefits. And that's all we're changing in the structure. We're not increasing people's mortgage amount. We're not having them take extra money. We're just diverting it, because as you prepay your mortgage down and you borrow from it, you're going to have that home equity line of credit. Yes, your mortgage balance is going to go down, but it's going to grow on the home equity line of credit side. Now,
okay,
what's going to happen is you're going to start getting tax deductions when you actually file your taxes. Now, this is depending on where you need to look at. Are you self-employed? Are you an employee? Now, someone that's an employee, the strategy is better attuned to them. The reason for that is, as an employee, you cannot bring your expenses down. If you make $120,000, you're paying about 40% in taxes. You can't bring that number down. We're able to do that with cash damming. We can actually help reduce your taxes by having those tax deductions on a write-off. That's where, let's say if you were an employee there, Alex, maybe you usually get like a $3,000 tax return. After 1 year of cash damming, we'll go over a real life scenario. we can increase your tax return anywhere from $1,000 to $10,000. What's going to happen?
Yes.
That's where the real benefit of this comes in. We now can take those tax returns. Those are funds you never would have had. They never existed for you before. Alex didn't have $10,000 extra. We're going to take that money and actually prepay your mortgage now. That is actually the debt going away. We're actually reducing your debt now by $10,000. And so that's where, when you have a rental property, the debt conversion, the mortgage to a HELOC, it happens anywhere from 5 to 8 years. That's how long it would take to convert your mortgage to a home equity line of credit. Once it's converted, like you said, Alex, you didn't really get rid of any debt. Once it's been converted, from there, all that's happening is that's then getting aggressively paid down. Now, this is where some people actually hold that debt longer. If their income is in a really high tax bracket, they might say, hey, you know what? I'm fine with keeping that debt for a little bit longer because it's helping bring my income expenses down. And that's just where this is not a strategy that you can go and say, hey, I'm doing this and only try it for 1 year. It's something that needs to be planned, and it needs to be reviewed every 6 months to a year. Because if your income levels change, this is all based on tax returns. If you stop paying yourself, if you're in a company, you have no more income, well, there's no benefit of doing this.
Yeah, folks. This is not a new strategy, and financial institutions actually talk about this strategy, and we're referring to National Bank, who had information about this, as well as Desjardins. Now, we do have to caveat this is not for everybody. Who this is for: rental property owners, which we're going to mostly focus on this episode; self-employed workers who are not incorporated, so sole proprietors, and partners of a general partnership. So that one is a little bit more complicated. We need to see a tax specialist on. And again, don't listen to this episode and say, I'm just going to go out and do it. Talk to a mortgage broker, talk to an accountant, and talk to a financial advisor who specializes in cash damage to make sure this is right.
It's
Now,
almost one of those ones where if you ask your mortgage broker, have you ever heard of this? And if they cannot answer you on the step there, you got to go find someone else. It's not something not one of those things of like, hey, let me go figure out this. I can help you learn it. It's something that you need to be in the weeds and fully understand in depth. Same thing for the accountant. Everything has to be documented very systematically to ensure that CRA is not going to get upset at anything. If you borrow from that home equity line of credit to pay for this rental, you're all good. If you go and buy a boat on top of that from that home equity line of credit, that debt is now muddy. The CRA, you'd have to show them exactly what went to the rental property, went to the boat. And so we have to keep everything very separate.
Yeah, so I'm just reading off here on the National Bank website, like how does it work? There are a bunch of conditions that you need to meet before it will work. So you do need to have significant personal debt, such as a mortgage or a car loan. Now, like if you're self-employed, high business expenses. Now, in the case of real estate, it'd be expenses for the rental property, and you need a good taxable income. So, like Alex said, if you're a salaried employee, you make good income, great. Even if you're a sole proprietor, you have a decent income, not like, if you have like some Etsy business working part-time, making, claiming only 5,000 to 8,000 a year, this probably won't work for you because you're not going to see enough savings to make it worth your while on this one. You need a certain amount of financial products. Alex, you want to touch on these?
Yeah, and so that's where you have to have a readvanceable home equity line of credit. Now, not every single bank out there actually supplies a readvanceable home equity line of credit. If you go to a credit union, they'll have a home equity line of credit, but it doesn't increase as you pay your mortgage down. If they've given you $100,000, you got a $400K mortgage. Even after 5 years, a home equity line of credit is only going to be at $100,000, and so that is a big thing with this. It has to be readvancing. You got Scotia, you got TD, you got RBC. Now, the problem with RBC in this, they only allow you to do a 10% prepayment every single year, and it's only a one-time shot. And so, again, it's very nuanced for the right lender. Another good one is Manulife. They have other things in it, National Bank. And so you have to be in the right product, and the lender can't say, oh, yeah, don't worry, I got a line of credit for you. It has to be readvanceable. And depending on how much rental income you have, if you have a lot of rental properties, if you can only do a 10% prepayment, well, you're not going to get the strength out of this. Where at Scotia, you can get a 20% prepayment privilege, double up your payments, and then you can aggressively pay it down.
Yeah, I believe BMO has one too. Is it called the Ready Line? I think.
Yeah.
I'm not sure what CIBC's one's called, but every major bank has a readvanceable product.
Yeah, and that's just
Yeah.
it. The big ones, BMO and RBC, aren't the ideal scenarios for this. Just the way that they limit the prepayment privileges and everything on it. And that's just where, again, it's showing people, and that's where when I do these strategies for people, if they're at RBC, I just tell them that we'll have to wait till it goes somewhere else, because if you get caught and I can't get the rate prepayment down, again, it's going to muddy up all your tax planning. And so that's just
Yeah.
where it needs to be in the right scenario to make it work properly.
Yeah, the full flexible ones, like you said, Manulife One, the Scotia Step, even the National Bank, they have an all-in-one, which is pretty good as well.
I mean,
So those ones.
it's also having ones that you can segment the mortgage and the HELOC. And so like some mortgage providers will only let you have one mortgage and one HELOC, which is fine. It will work, but it's really nice if you ever do need to do something personally that I can say, hey, I want 100,000 for my personal on this line of credit, and the rest goes to the HELOC, the cash damming. Just so again, it's solely for tax planning.
Yeah, a few other conditions here is, obviously having a separate bank account for your business income, i.e., same thing like a rental property. Now, this National Bank says you need a second bank account for your business expense. I was kind of wondering about that because most of the time, if for my rental property, the same bank account that pays the strata fees, mortgage payments, and all that stuff is the same bank account that I deposit the rental income or the e-transfer rental income. Like, is there
So
is
the
there a
flow,
reason why? It's because the flow, right? Just to
not
make sure
really like
it's
all that really wants to happen here is you want a checking account and what's called a clearing account. You want something that where your HELOC is going to get transfer from. Some of this stuff can be automated. Some of it has to be manual. Let's pretend we're talking about Scotia here. So, hey, you got your bank account for your rental property. That's where all your expenses are going to come from it. Your property taxes, your mortgage payments and everything. We need to have that set up so that your HELOC, we can pull the $3,000, goes into that account. That's where it's going to go and pay all your expenses. Your deposits from your rental income, it can kind of go wherever. It's just kind of nice having it in a separate bank account. But the most important thing is where the HELOC goes and where the expenses come from. That's like the most important thing.
Yeah, you do touch on it because we're getting away from the rental property being its own separate entity. We're now mixing it, and by having that second account is because we're using the HELOC from your personal residence to pay for the expenses on the rental. That's why you have to separate. I'm like, oh, that means you have to pay another, $4 or $7 for another bank account. But there's a purpose behind that, just to keep it as clear as possible.
You can borrow from a HELOC for this. Now,
Yeah,
what
yeah.
people have to understand the way that the strategy is that you're going to say, well, I'm also going to have to start borrowing from my HELOC because I'm going to have expenses on it. What's actually going to happen, say the first month you do this, you borrow $3,000 to cover your rent, your mortgage, property taxes. Well, the next month you're going to owe interest on that HELOC. For the strategy actually to work, you actually borrow more money from your home equity line of credit to cover that. The whole point of the strategy is to help you pay your mortgage down at no extra cost to you. I could just go tell you to go buy a rental property and say, hey, put extra money on your mortgage. The whole point of this is to not increase your cost and still have you pay your mortgage off faster. And so you're borrowing from your home equity line of credit to cover the interest on the home equity line of credit.
Absolutely. And folks, getting a mortgage with a readvanceable line of credit, it's more difficult to qualify for than just a regular mortgage. The reason being, we need to, the saying that we need to qualify at 2% or more than the contract rate. We need for the mortgage and readvanceable line of credit, we need to do the 2% on top of the HELOC rate, which is often 1% more than what we qualify on a mortgage. So not everyone can qualify for this. Make sure to qualify. Obviously your income is high enough and you have a good enough credit score.
And that's where, like, bringing it back, Alex, this is where I find it can be a very good sales technique to say, hey, And we're going to talk about a number here. And in over 30 years, we're going to show you how you could potentially increase your net wealth by 1.4 million. We could just talk about that number and everyone's going to eat it up. Now, the problem I have is, well, what if we do this on a property that maybe is not your forever home? We can bring it to a next property. Like, this is something that can move. But let's say, hey, you started $1 million property, and then down the way, you want to go get a $1.6 million property. Maybe you don't have enough money to actually put that 25% down we would need to see to have that home equity line of credit. You now may not be able to do that. And that's where, when I sit with people, it's helping them plan for the future as well. It's great to say, hey, you go do cash damming. Well, hey, you now can't go buy another property. And that's where it's not looking at just that one savings, because I'd rather own 3 properties than just do cash damming on one property. Same thing, once you start buying more rentals, it's also looking at should these be in a holding company. If you buy rental properties, you can actually put them into a holding company, and that's another full-on plan. If it's inside of a holding company, you can't do this strategy. That's a business. That's an entity, and it cannot be used for cash damming.
Yeah, so cash damming only works for rentals if they are personally held.
Exactly.
Right. And at the same time, we're talking about self-employed. If you're not incorporated, if you're a sole proprietor, if you are incorporated, this strategy will not work for you.
You can do it. You can do it there, Alex. It depends on how much you pay. And so, like, let's use myself personally.
Oh yeah, you can be incorporated, but the income part doesn't apply. It's the rental property that you cash dam. It's not the business part.
For me, it's better for me. Like, I could pay myself a higher income and show more income and do this, but I would much rather keep my money inside my company and pay less in taxes. And so again, when I sit with people, it's like, hey, yes, I could help you do cash damming, but what would be the point of that? Why don't I restructure your business so that you can live on your life at 60,000 instead of 200K? You still get all the mortgages you want, and hey, I've now saved you $1 million in taxes. That's where I just find it's a very easy strategy to sell people on, hey, I can help you make 1.4 million, but there's a lot of other stuff that needs to be looked at.
Yeah, and then especially like you were touching on, if the goal is just to own that one rental property, that's great. But what if they want to acquire another rental property and another? Then, like you said, cash damming might not work, because the idea of having it is you probably need to hold the property at least 5 to 8 years to see any benefit from this, right? And oftentimes when we own rental properties, for those who do, life happens, and maybe you're short on cash flow in your personal life. Maybe you got laid off with work, or business is down, and you need to sell an investment just to liquidate and use, to live off the capital gain or whatever. That just destroys the cash damming strategy, doesn't it?
That's where you could sell your rental property, but let's say you then have that investment, your principal residence, and you had been borrowing it. You now are going to have to pay off that debt, because it's not going to be tax deductible anymore, because you don't have a rental property. Now, there's different nuances here, and we're going to break down a real life scenario here in a second, and that's where it's helping people look at those numbers. Now, you can say, hey, I only want to buy a rental property, and you may be able to be mortgage free in 8 years, 10 years. It just depends on what you want to do. I would say this is a strategy more for someone that already owns multiple rental properties, and they already have their nice house. They've already found that. That's a better suited strategy for them. I had one guy that he has 5 rental properties. We've been in cash damming for 2 years for him. He's about to be mortgage free in 2 years. That's how aggressive he was able to do it. But he already had all these things. I didn't help him buy an investment property. I just helped restructure everything for him. But he's going to be mortgage free on a principal residence in 5 years compared to 25 years.
Wow, that's amazing. Now, before we get into the numbers on, like the cost benefit, you can do cash damming. Like, can you clarify? Can you do cash damming if you have multiple rentals, or only with one rental?
We can do it as now. The thing is, like I talked about at RBC, hey, there's only a 10% prepayment privilege. Depending on how big your mortgage is, you may not have enough room to be doing the prepayments. And so that's where, yes, you could have 100 rental properties and try and do this, but you're not going to have enough room to be prepaying the mortgage. It's going to depend that way, but you can do it with multiple ones. You can have 3 other rental properties. You're going to flush all that rental income through the principal residence and borrow it to cover all those expenses.
Excellent. All right. Well, we should talk about numbers, right? Alex, do you want to go through them?
Let's do it. And so what we're going to do, everyone, is we're going to give some screenshots after that you guys are going to be able to see that we're going to talk about some of the actual financial benefits, how the cash flow cycle works. I'm mainly going to paint a picture here. This is a real life client. This is someone that came to me recently, and we've just started cash damming for them. Now, what's going on here is they bought about 6 years ago, which was a really good time to buy a house. If anyone realized, they had a mortgage of about $350,000. Their home is now worth $1 million. They were going to be mortgage free in 21 years. That's what they would be at right now if they pay it. They've already been wanting to get an investment property. That's something that they already wanted to do. This is just adding another layer to it. It's just great to say, hey, yeah, great, you're going to be able to go buy that investment property, but we're also going to help you pay your principal residence off faster. They have the house that they love. They've been there. They don't want to go anywhere else. So we're going to pretend, well, not going to pretend, their value of their home is worth $1 million now. We are going to refinance them. We're going to get them a new mortgage up to $500,000. That is going to give us the funds to use for the down payment on the rental property and have the mortgage that they currently have. What we're going to do is we're going to segment that mortgage. We're going to have their principal residence mortgage for the $350,000, and then we're going to have the $150,000 for the down payment, because you can write off that interest on the down payment to buy an investment property. So we want to make sure for tax planning that is also already documented. What we're going to be doing is we're going to be paying that mortgage now off faster. What these clients did is they went and bought an $800,000 investment property. We got a mortgage right near $600,000. Now, with their mortgage payment, their property taxes and expenses, because we want to include utilities, all that stuff, their expenses come out to right near $3,400. Now, for the rental income, they're only getting $3,500. You could say, awesome, it is cash flow positive a little bit, which is a nice number. Now, when you get into cash damming, there's assumptions that we have to take into. This is a calculator I have, and this is where we have to take into some of these assumptions, Alex. I like to look at it. We know in BC, the value appreciation rate on homes is more like 4 to 5%, depending on the area. I don't like to use those numbers. Again, I could use that to sell someone, hey, look at this. If you buy this place, it's going to appreciate at 3% over the next 20 years. You're going to be a multimillionaire. I like to use 1%. I use a 1% appreciation. If this was in Alberta, I would use a 0% appreciation just to show people what that different number looks like. The other thing that we have to look at is expenses also go up on a yearly basis, anywhere from 2 to 3%, but you can also increase your rent 2 to 3%. So we have these assumptions built in. It's going to appreciate at 1%. We have the cash flow increasing at 3%. That's for your expenses and your rental income. This is with them. They're at a 40% marginal tax bracket. So you do need to know what your marginal tax bracket is to figure out, okay, what's my tax benefit going to be here? Now, what's going to happen here, and we'll show it on the financial benefit side. What's going to happen is these people are going to convert their mortgage, that $500,000, over to tax-deductible debt in 8 years, meaning that $500,000 is not a mortgage anymore. It's fully on a home equity line of credit. That's going to happen.
Can I pause you 1 second while you're explaining? So when you said that 350 was their principal residence, 150 was for the rental.
Yep.
The rental income is paying off the 350 while that 150 still stays the same, right? Is that what you're saying?
It's the 150 is also going to get paid off in the end, but it's more just like for tax planning, like the accountant can write off that 150 also. It is gonna, okay. It's all gonna start happening no matter what.
Right. But from a logistics standpoint, if I were to prepay from the rental income, I would be paying down the 350 portion, right?
I'd be telling them, I'd be saying, hey, we're going to prepay the 350 one. We're going to leave the 150 for less.
Right. Okay. Yeah. I just want to clarify for you folks there that, you're getting lost with Alex explaining things. I just want to follow along. Like, okay, that's what you mean, go ahead.
That's where there's so many nuances. And that's where I just set one person up and she's got three segments for her mortgage on her one property. We have her other rental property with 3 different segments just for all the different stuff we have. And one day she comes like, Alex, where's all these different accounts? I said, all right, come meet me. I'm going to set it up in her bank account first so I could actually label them. The problem that the banks have is they just say line of credit 1, line of credit 2, line of credit 3. You don't even know where they're going. And
So
so
you almost had to get them to nickname it on their bank account.
yeah, that's what I did. I nicknamed it for each one so that she fully understood where and what each account is actually doing. Because again, this is not just some easy strategy. It's not something that, hey, you're just going to take this. There's nuances to it and everything. And so that's where over 8 years, they've converted that 500,000 all the way into now a home equity line of credit. What's going to happen?
Sorry. Back to the example.
What's going to happen is, in this case, they're going to get total tax returns over 19 years, because we're going to talk about that in a second, of 78,000. Now, in this case, that's not that high, actually. That's a pretty low tax return, to be honest. That's just because they're actually getting good cash flow from the rental property. One thing for people to know, if you are negative cash flow, you can actually use cash damming to actually eat that negative cash flow up. You can actually have a rental property that's negative cash flow and use this strategy to not be negative. It's not going to be as powerful, but that's where there is a lot of people that are having to do that because they bought back in 2021. Thinking rentals were going to keep going up.
Yeah, I see that those who are listening from the lower mainland and GTA, I'm like, well, that's great. Positive cash flow. I'm like, what's that? Negative cash flow. I'm sure you're talking to them right now.
Yeah, and so that's where you can use it, and that's where you can stop the bleeding a little bit. Let's say if you're used to paying $600 a month out of your pocket, that's where you can use the strategy to stop that. Now you have two options. You can either keep that $600 to do the other stuff in your life, or you can go invest it now. And that's, again, where we can break down some other scenarios. The big benefit here, these people, we refinanced them to 30 years compared to their 25. They were going to be mortgage-free in 20 years. They're still going to be mortgage-free in 20 years. They started at 30. We're going to get them mortgage-free in 19 years. What that does for them, Alex, it's going to save a number of payments of 128 payments. They now don't have to make 128 payments, which comes out to a savings of $318,000. That's how much they're going to save because they now don't have to make those payments for the next 10 years. The other thing that people don't realize is we make our mortgage payment in after-tax dollars. We make a net income, say, of 100,000, while our gross income of 100, our net income is actually 60. So if you actually look at your pre-tax savings, it's actually $531,000 because you don't have to make those payments anymore. Now on this, what you're going to see is there's two different options here. You could say, hey, I actually just wanted to do this because I want to be mortgage free in 10 years. They actually could sell the rental property in 10 years. This is accounting for capital gains. It's accounting for realtor expenses and everything. We've already built that into the spreadsheet, and they're going to pay off the primary mortgage. That means in 10 years, they can be completely mortgage free. They had started when they came to me at 20 years. They can be mortgage free in 10 years now, that's a pretty awesome thing to say to someone. Mm-hmm. If they keep it though for the entire time, they're going to be mortgage free on their principal residence in 19 years. That's what they're going to be free. Now, what we would be recommending them, and this is why you want to sit with a financial advisor as well, is say, hey, you already plan on paying this for 30 years. You are comfortable with doing that. We're going to take those mortgage payments over the next 10 years. You're going to go invest that money. If you invested it and got a 5% rate of return over the next 10 years, that's going to give you $444,000. That's the money you've now saved. Your rental property after 30 years at a 1% appreciation rate, if you bought it $800,000, is worth $1 million. You've now increased your net wealth there, Alex, by $1.45 million at no extra expense out of your own pocket. That's where it is a very powerful tool. If you want to increase your net wealth and increase like owning a real estate, there is no strategy that's better than this, but it has to be used in the right way.
Oh, that's amazing. I mean, there's a huge caveat to this too. Like, once you pay off your mortgage, you have to treat like you're still making that payment and using that payment to go to an investment. You're not all of a sudden just blowing that money now that you don't have a mortgage to pay.
Even let's pretend if you didn't, you would still be you own a rental property that's paid in free because the renters paid it. You have a value of $1 million. That's you never would have had that if you didn't do this and it didn't cost you anything extra. Of course, you could just go and invest $3,500 a month if you could, but you can't do that. You don't have that cash flow. The renter's paying down the mortgage after 30 years, it's worth $1 million. You don't owe anything on your principal residence. You don't owe anything on the rental property. Even if you didn't actually do the other investing, it still increased your net wealth by $1 million.
Yeah, yeah. I know a lot of people. A lot of people have investment properties, and just like you and me included. Once our rental properties are paid off, we use the rental income as essentially our pensions,
Exactly.
because no RSPs or anything like that we have. But yeah, go on.
Let's do one thing here. Let's remove the 1% appreciation. Let's pretend that the appreciation is gone. That's where the net improvement, if we talk about it, if you didn't do the other investment savings, it would still be $750,000. You've increased your net worth by $750,000 and no extra money to your cost. That's where I like to show people that. And that's where, if you're in Alberta doing it, bank on a 0% appreciation rate.
Mm-hmm. Yeah. So, I mean, it's good that your calculations here, folks, we are going to put this graph on the YouTube on the visual side. But it's good that you accounted for things like expenses increasing, a modest appreciation, because, in the GTA and the Lower Mainland, we've seen appreciation of 4 to 5% averaged.
I mean, look at this scenario.
Like,
if we want to really again, sell this to someone, as if we put a 3% appreciation there over 30 years, this place will be worth 1.8 million. It's very hard to see. Now, I bought a place back in the day for 400,000. That's now worth around that number. So, I mean, it is very possible, but I don't want to give people a fairy tale. I'd much rather show them, say, hey, this thing could appreciate at 0% and it could still help improve your net wealth. That's an actual powerful tool. Just solely banking on appreciation, we know what happened with the pre-construction.
Yeah, exactly. So again, folks, this strategy is not for the faint of hearted. There, like we touched on earlier, there's a lot of caveats to it. Talk to a professional.
Let's go back here. I'll show here like how the tax refunds start, because the tax refunds at first, like they're not great. They start to build. In the first year, by doing this, you're going to get an extra tax refund of $445. Now, again, if you're an employee, you're probably going to get a tax return. If you were self-employed, what's going to happen is you're just not going to have to pay an extra $445. And again, that's where I think people get confused. They're like, awesome, I'm just going to do this strategy and I'm going to become rich. It's like, you have to do something with money that we've now saved you. Either have it decreased your tax bill for you, or have actually put money back in your pocket. In year 2, you're going to get about $1,300. Year 3, you're going to get $2,100. Year 3, you're getting $3,100. Year 4, you're getting $4,000. Year 5, you're getting $5,000. Year 6, you're getting $6,000. Year 7, you're getting $7,100. That's at year 8 is when you fully debt converted. So your max tax return would be $7,500. From there, that debt's now going to be getting aggressively paid down. So then your tax returns start to go down from there. But that's where those funds, that $7,000 that never existed before, it's funds that we've created by tax planning. That's what people really have to realize. This is tax planning.
No, this is amazing. Again, folks, we're going to have a bunch of graphs on the visual side so you guys can see.
I thought
any close? Yeah.
Let's bring this one up, Alex, just to talk about the cash flow cycle, because we can bring this one up for people. And so again, it's showing people how the flow works. So we have to remember, you got your rental property, all of expenses equal to $3,400. We're going to take that when you have it. We're going to have that in one account. That's where you're going to pay it. You get your rental income. We're going to prepay our property. We're going to prepay our principal residence, $3,500, because that's what we get. We're only going to borrow out the $3,400 because that's all we can actually write off. You're going to prepay your mortgage by $3,500, but we can only borrow the amount that we actually can expense. I can't say, hey, we're writing off $3,500 because there's not $3,500 in expenses. Now, throughout the year, we have to go through, some stuff comes in on a monthly basis. Some of it comes in on, hey, I got to fix my fridge. I got to fix my roof. Those are all expenses that we'll get to do, but it just depends on, is it on a monthly basis or a yearly basis?
Or even a one-off thing like, oh, I had to replace the hot water tank or something, or there was a leak in the roof or something like that.
Yeah, and so that's where we have to, again, this is a strategy that's when you get a mortgage, I bet you your bank probably only calls you once a year. Maybe they don't even call you once a year. With this, you need to be meeting with someone on average at first for the first like 6 months, once every month. From there, it needs to be every 6 months at minimum after that, readjusting everything. Because that's where, for one, if you are self-employed, what if your income's going to be down that 1 year? Okay, this is taking an assumption on the calculator that your tax bracket's at 40% for the next 30 years. So that's why we have to be changing these numbers all the time.
Mm-hmm. No, this is great. This is great. Yeah. Any closing thoughts on cash timing? Anything that we haven't touched on?
No, I always love it's a tool that I love, Alex, and I love talking about it. It's just I just find I always talk about, I could post it on social media more and you get a lot of people, but it's not for everyone. It needs to be looked at in the right way, and making sure it's analyzed. And that's where I think we should do another episode, Alex, on like the Manulife One account, talking about like an offset mortgage. Again, there's a way you can pay your mortgage off really fast if you have a high income, but it's actually the best thing to do. And is everyone going to use it in the right way?
Yeah. No, I'm familiar with that product. Yeah, it's very niche. So we'll probably have another pod about that pretty soon.
I did want to bring up on this. It's a lot of people get caught up as like, oh, I have to own an actual rental property. As long as you have a rental suite, you can also do this with your home. If you have a house and a rental suite, we can take the square footage of it and we can do it on the square footage of it also as well.
No, that's amazing. That's a lot of people who don't have a rental, but they have secondary suites for sure.
But you need to claim the rental income now, Alex.
Oh yeah, of course. Some people don't, but yes. You can't have your cake and eat it too, folks.
Exactly.
All right, folks. Thanks for tuning in. You've been listening to episode 38 of Cash Damming with Alex Shanks, Alex Pang. We'll see you next time.
Now, if you enjoyed this episode, make sure to like and subscribe. If you're listening on Spotify or Apple, make sure to follow us. Please give us a 5-star rating. You can even send us an email because we want to know what you guys want to hear about. That's what we're here for. Reach out anytime.